Imagine collecting a monthly cash dividend that adds up to nearly 9% a year, while holding a stock that climbed roughly 24% over the last 12 months. In a market where dividend stocks rarely deliver both yield and growth, that stands out. Today, we're looking at Cardinal Energy, ticker CJ on TSX, which is one of Canada's highest yield monthly dividend stocks. And of course, this is not financial advice, do your own research. I'm not getting paid for this, but simply showing you how high the dividends can go up on a stock and what goes into it. Without further ado, let's get right into it. Cardinal Energy is a Canadian oil and natural gas producer, obviously, with assets in Alberta and Saskatchewan. The key advantage here is low decline conventional oil production. Look, most oil producers need to constantly drill just to keep the output flat. Cardinal doesn't, or does to a small extent. Let me explain. Production declines slowly, which means less capital is required just to maintain volumes, and more cash can be returned to shareholders through, you guessed it, dividends. On top of that, Cardinal is now expanding into thermal oil, which is this new thing, a long-life production method that, once running, provides a very stable output and pretty strong cash flow for a while. That shift is central to the company's next phase. So look, Cardinal currently trades close to $8 per share. Over the last 12 months, the stock has returned roughly 24%, not including dividends. That means investors earn meaningful yield and capital appreciation. And yeah, you can buy Cardinal on Wealthsimple. If you invest in Canada and use Wealthsimple, it's available like any other TSX stock. So they're publicly traded. And if you haven't used Wealthsimple before, I have a full walkthrough video on the platform. It's pretty simple. Check it out after this breakdown, if you want to see exactly how to use the platform and place trades. Anyways, let's talk about the dividend. Cardinal pays $0.06 per share every month, which works out to about $0.72 per year. About a 9% yield at today's prices. This is a monthly cash dividend, and the company confirmed it consistently in August, September, and October of 2025 announcements. Steady, repeatable monthly income is the core of the appeal here for a lot of people. In the second quarter of 2025, Cardinal produced 21,184 barrels of oil equivalent per day. Adjusted funds flow was $49.4 million, and dividend payments totaled $28.9 million. That's about 84% payout ratio. So the dividend is covered, but there isn't a huge margin for error. Net debt at the quarter's end was $227 million, or 0.9 times cash flow. That's a comfortable leverage level, especially considering where the business is in its development cycle. Anyways, the biggest catalyst here is the Reford thermal project in Saskatchewan. The construction was completed on time, somehow, and on budget. Steam injection began on August 21st, 2025, making the start of the heating phase. The company expects production to ramp up in early 2026, ultimately, per their projections, adding 6,000 barrels per day, which is roughly a 30% increase in production, taking the output into the 27,000 barrels per day range. Management expects to begin paying down debt in the last quarter of 2025 as spending winds down and the asset starts producing more cash. So right about now. This marks a shift from the investment mode to a cash harvest mode, where they try to make as much cash as possible. Let's look at their capital. In the first half of 2025, Cardinal drilled one conventional well. They focused capital on completing the thermal project without sacrificing the production stability, a benefit of a low decline asset. The company also voluntarily reduced its credit facility, lowering the standby fees and signaling confidence going forward. But, of course, it's not all perfect. There are risks, and 9% yield comes with some real risk. Cardinal operates in the commodity business, oil. So if oil prices fall sharply and stay weak, cash flow and dividend could be pressured, as well as the stock price. The payout ratio is really high, leaving a little buffer. Thermal projects can face variability during early ramp-up phases, and their debt rose during construction, making execution and commodity prices important over the next few quarters. So this is not a fixed income replacement. It's a very high yield equity with sector exposure. Know what you're buying. The Cardinal is suited for investors who want monthly income, understand commodity cycles, and can handle volatility. But look, if you're looking for stable bond-like dividends, this really isn't the right pick. If you're looking for yield backed by real production growth and are comfortable with energy risks, it's absolutely worth considering. But keep in mind the risk. To To summarize, Cardinal Energy delivers one of the highest monthly dividends in Canada right now, supported by their low decline assets and a major thermal project that's now online. The dividend is absolutely real, the production is real, and the cash flow, in a perfect world, should increase very meaningfully in 2026. Execution and oil prices still matter. But for investors willing to accept those risks, Cardinal is one of the most compelling income stories in the Canadian market right now. Something worth checking out. But remember to always do your own research and make sure that this fits your personal risk profile and investment goals. Anyways, thank you guys for watching. If you found this useful and interesting, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss future breakdowns. Drop a comment below if you're currently holding Cardinal or any other oil stocks, or thinking about adding it. Or if there is another Canadian stock you want me to analyze next. And as I mentioned, if you're interested in using Wealthsimple to invest, check out my full Wealthsimple walkthrough video. It's linked in the description. Thank you for watching, and I'll see you in the next one. Take care.